Hello, friends. James Stevenson here. And yes, I am going to do it. I'm going to make this video. So for those of you who haven't been following the back and forth drama here, after Tesla reported Q2 earnings, Real Meet Kevin Paffrath put out a video calling the earnings a disaster. And a few people watched that video, tagged me on Twitter and said, "Hey, James, can you share your thoughts on this video from Kevin? We trust that you've thought through these topics he was talking about. Can you share your opinions?" So I did. I made a video about that. And then he watched that video. He didn't reply to me on Twitter. He just made a point-by-point rebuttal of my video and uploaded that to YouTube. So I watched that video, and a lot of other people did, and said, "Hey, James, give us your thoughts on that video." So I will. Hey, who doesn't love a good, intense balance sheet discussion? Let's talk about current ratios and quick ratios. That's riveting television. So what I'll do is bring up my second screen here. And I guess first I'll bring up Twitter. Yeah, this is okay. So here's that first video that I made, just asking for Kevin's thoughts on it. And here's the video that that he made in response that I watched. And what I can't do is the cool, slick, heavily edited reaction video style where I play his video, pause it, and react to it. And I'm afraid if I did that, this would be a very long video. I don't know how long this video is going to be, but you do, because you can hover over the video time scrubber and see how long it is. I'm going to try to go fast through it and respond to his points, because I wrote down notes on the claims that he made, and I'll just share my thoughts on those as we go through them. Yeah, I really am doing this. All right. So here's my spreadsheet. Let me scroll up here some. So reaction video 2. Here's the claims. I made this a little bigger than in the previous video, so hopefully you can see this better. And hopefully my image in the top right corner is a little bigger because I made my desktop resolution only 1080p instead of 4K. So hopefully you can still see me in the corner and my pretty LED lights back here, or whatever. All right, let's jump right into the content. The first thing Kevin said in his video was, "Tesla permabulls like to go la la la, Tesla can do no wrong." What? What's a permabull, Kevin? Is that someone who decided Tesla was a good investment and hasn't changed their mind about it? Because that's me. Yeah, I decided Tesla was a good investment and I haven't changed my mind. But I'm not sure how helpful that tone is for constructive dialogue. All right. Next claim, Tesla permabulls don't like to think about PE ratios. Well, I love talking about PE ratios. I can show you some in my detailed forecast model that I have here. Let's see, here's my detailed model. And hey, look at this. I've got P and E and G. We haven't gotten to growth yet, but I like talking about PE ratios. I got a few different ways of calculating them here. And I got some PEG ratios here. I got some Peter Lynch price targets. I got Stevenson indicator. I got a lot of fun stuff happening in my forecast model. So not sure why you think Tesla permabulls, which I think is Kevin's nickname for me. He calls me Tesla permabulls instead of referring to me by name. All right, the next claim here, I'm going to try to move fast, is let's be generous and say Tesla will earn $25 in 2025. That is not generous. That is crazy, wrong, low, and Tesla might beat that number in 2023. Just to very quickly show you what's in my detailed forecast model. Here is non-GAAP earnings per share diluted here on row 1,235 of my detailed model. And here's 2023 over here. So if we drag a box around these 4 quarters next year, I'm over $32 for 2023 earnings. So I can't agree that you've been generous in saying that Tesla will earn $25 in 2025. Tesla might earn triple that in 2025. Um, I know you're not giving a lot of credence to full self-driving, but Elon has already expressed his intention to raise the price of full self-driving soon and to continue doing that into the future. So if you were on the fence about whether or not to order your Tesla with full self-driving now or to wait to place that order, I would encourage you to go ahead and get that order in before the price of FSD goes up, which may happen at any time. There's not always a lot of time delay between Elon saying the price of FSD is going to go up and it actually going up. And the more valuable those features become, the higher the price Tesla can charge for it. Pricing is based on what the market will bear, and the more value the market perceives in a product, the greater value companies can extract from selling those products through pricing. So the next claim here is that PE ratios are important to understand in the context of growth. And yes, I have that shaded green here as indicating that I agree with Kevin on that one. Let's take a look at how Tesla is growing earnings, and we'll continue to do so. So back over here on my detailed model, well, what's happening in the income statement? Let's scroll on up here to row 1,169. That sounds like a fun number. 1169. So what's happening next year that's different than what happened this year? Well, Tesla's going to continue to grow revenue. So Kevin spent some time in his video talking about how companies that are growing revenue quickly are more valuable than companies that aren't and command a higher PE ratio. And that's all true, and it makes sense. If you're a long-term investor, you ought to pay more for a company that you think is going to be growing their earnings by a lot in the coming years, as opposed to a company that won't be. That just makes sense, right? You want to pay for the expected future earnings of a company. The earnings that have occurred already are in the rearview mirror. That is, like the death of Julius Caesar, those are both ancient history and not to be considered in your decisions about what stocks you would want to invest in, right? That decision is based on forward earnings. Forward cash flows are the only thing that matter. So in the future, the revenues will be higher from automobiles and from Tesla's other lines of business, which will make their total revenues greater. Tesla's also going to be improving their gross margin percentage. So we should see this get better with Tesla's factory open for the whole quarter. And I apologize that these Q2 numbers are not updated yet. I wait until after I've read the 10Q before I update my most recent month of actuals column to make sure I understand everything that was happening there to adjust my model correctly. I'm not just typing over the totals. I'm going back into my detailed granular assumptions and changing things like production rates, number of weeks of production, cost of sales percentages at the option and model and site level by quarter in this model to build up to these totals that you see. And then these are going to be growing by more than the operating expenses. So research and development, SG&A, restructuring and other. Hopefully we don't see more Bitcoin impairments in the future. That's a tough thing to try to forecast the timing of. So it's easiest to just plan for zero there. And yeah, that's how you get to more earnings, right? If you're going to do broad brushstrokes, that's why Tesla's earnings are going to be growing in the future and why Tesla ought to have a higher PE ratio than companies that aren't growing earnings as quickly. And I do have down here earnings growth percentages. So what is Tesla's earnings growth rate? These are really big numbers. These are actuals over here, by the way, at this point. And then I have to forecast them going forward for how much I think the earnings rates will be. And yes, the earnings growth rate is going to slow some, but it's not going to get down below 50%. That's not where I have it for a long time into the future. So Tesla is going to remain a growth company for a while, in my estimation. And I realize reasonable people can disagree on these forecast assumptions, but I'll keep moving. Tesla should trade at a higher PE multiple than NVIDIA, which is only growing earnings at 15% per year. Why would I pay 4 times that for Tesla? Well, I agree with the first part of this and not so much the second part of this. So what NVIDIA has that makes them different than Tesla is a whole bunch of direct competitors that are also selling silicon chips, right? So Intel, AMD, Samsung, a whole bunch of other people make chips that people can buy that do the same thing that NVIDIA's chips do. Now, NVIDIA's been really good at graphics cards for a really long time. So maybe people will apply a premium to the NVIDIA chip and say, hey, they really know what they're doing. We can trust their product more. But there are direct competitors for NVIDIA that buyers think are equally good value for price paid. Why is that different from Tesla? Well, the easiest evidence for this is to go ask short sellers and haters on Twitter, who I talk to frequently, hey, which of Tesla's competitors is offering the most clearly superior EV buyer experience? Which, is it Volkswagen? Is it Ford? Which of Tesla's direct competitors is offering the most clearly superior total EV ownership experience to their customers? And you'll never get the same answer twice, right? And I think what this means is, and what we can see from the market's reception of Tesla being the best-selling EVs in the world, is that the market is telling us, and even Tesla's detractors are telling us, that there isn't a comparable value for price paid being offered by anybody else. Tesla is clearly world-class, clearly superior in offering a better product and a better overall ownership experience, including stuff like the supercharger network, so you can take road trips and not have to slow down, because along your path there will be ways for you to quick charge your Tesla and keep moving wherever you want to go. So stuff like that sets Tesla apart, the software, the safety. I could go on, but I won't. I'll keep moving down the list. So Wall Street values stocks based on perception. Well, okay. And then Kevin's talking about, hey, the cash balance didn't grow a lot this quarter. All right, well, Wall Street can worry if they want to. I am not day trading. I'm investing. And what I see is over the long term, Tesla is a disruptor moving into the EV space more capably than anyone else is, and is likely to take the most profitable portion of the auto market share moving forward. So that's where my money is invested. And if Wall Street wants to trade news up or down in the meantime, they're welcome to. Doesn't bother me. The next point Kevin made was a lot of people got their panties in a wad because they didn't like how I did my math. And then he talked about a current ratio and a quick ratio, or an acid test ratio. These are the same thing. And so what I want to do is bring up, let's see if I have it here. So this is Tesla's earnings release. I'll come right back to this. But if you just Google an acid test ratio here, people ask, what does the acid test ratio measure? Well, this is how you calculate the acid test ratio, or the quick ratio. It's the most liquid current assets that can be converted to cash within 90 days versus the current liabilities, right? So if you do that math on Tesla's balance sheet, let's see here. So let's look at the current assets here. So you got cash, you got short-term marketable securities, you got accounts receivable, money that people are going to pay Tesla soon. You got inventory. Now, Kevin said he wants to throw inventory out because it doesn't meet his definition of a current asset. So my problem here is that Tesla is turning their inventory every quarter. So all the vehicles Tesla makes every quarter are getting sold within that same quarter, with the exception of just a few. And you can see that if we go to a different page in here, pardon my scrolling. So if we go to page 6 in here, there's a line called global vehicle inventory days of supply. And what you can see here is Tesla getting more and more efficient over time, reducing the number of days of finished goods inventory in their ending count. So of all the vehicles Tesla had to begin the quarter and then produce during the quarter, they sold almost all of them and then had very few left, right? So what you're doing here is measuring, okay, how many days worth of finished goods inventory did we have? And a year ago this time, it was a 9-day supply. And then it became a 6-day supply, a 4-day supply, a 3-day supply. And even in Q2, which was a very tough quarter, only a 4-day supply. That's really good. 56% reduction from the prior year, which was 9, right? So if I go back to the balance sheet page again, which was page 25, yeah, here we are. I'm going to count this inventory as being a current asset. Why am I doing that? Because Tesla is going to convert this to more money than that by the end of the quarter. It won't be $8 billion when Tesla sells it, because Tesla makes a gross margin on top of their carrying cost on this inventory. So if anything, I'm being conservative counting that as a current asset, because before the end of the quarter, Tesla is going to convert that into cash. That makes sense. Next, and by the way, that's how the formula works. You're not supposed to throw inventory out, and that's in this definition that we just looked at over here. Yep. So back we go to the balance sheet. I'll keep moving. So there's your current assets, $31.2 billion. And then down here are your total current assets, 21.8 billion. Now, I'll flip back to my notes to make sure I'm not forgetting to say anything. Okay, so Kevin described the math he did as nuanced. And I agree that there is a lot of nuance in the math Kevin did. So one of the things he did was pretend that inventories aren't convertible to cash in 90 days. And for some companies, that may be true. But for Tesla, that is not true. They are converting their inventory to cash within 90 days. And the comment that I put over here was, hey, weren't you the guy saying you wanted a backlog? So either Tesla has a backlog or they don't. Either Tesla has buyers lined up for this inventory or they don't. And they do. They do have buyers lined up to buy these cars as soon as Tesla can produce them, ship them, and deliver them, which happens in less than 90 days. What else did he assume in his math? He assumed a worst case scenario where we pretend all customer deposits must be returned. Well, that's a bit dramatic. I don't think it's likely that Tesla will need to return all customer deposits. I think it's likelier to assume that Tesla is going to hold the cash that people put down as customer deposits until the date that they deliver those models, you know, semis and Cybertrucks and Roadsters and whatever else is in this customer deposits. And that most of this is going to be realized as way more revenue than the amount of the deposit, because people will be applying the amount they deposited toward the much larger purchase price of those vehicles on which Tesla is going to make a profit. And the next thing he ignored was prepaid expense assets. Well, that's a really tricky one to ignore. And if Tesla hadn't prepaid them, would you be ignoring them? No, you would not, because they would still be in cash and cash equivalents. So if you wouldn't have ignored them if they hadn't been prepaid, how can you ignore them after they are prepaid? That's not consistent internally. And then he also ignored the deferred revenue liabilities, which was what he said he was going to do in the first place. So I guess he found a way that did balance to 1.05, still a positive number. But the important thing to note here is that if you do it the textbook way, either way, current ratio or quick acid test ratio, in Tesla's case, you get the same answer either way. It's about 1.5 or $10 billion to the good. And if you disagree with that math, I'd like to see how you did it in the comments below. So let me know what you think about that. So in the quick acid test ratio, you're only counting the assets that can convert to cash in 90 days. I would argue that there's an asset not being counted here that can be converted to cash in less than 90 days. That's not in the current assets section at all. It's down here on the digital assets net line. How do we know that? Because Tesla did convert about $1 billion worth of this into cash in less than 90 days during this quarter, right? So they transferred money out of these non-current assets or longer-term assets into cash, which is a current asset. So this was just a flip between two asset classes, one of which is outside the current assets for whatever reason. Wouldn't you figure digital assets ought to belong in the current assets group? They don't. That's probably a conservative gap treatment that Tesla's forced to report them down here. But it's very obvious to me that you can convert Bitcoin in less than 90 days into cash. All right. So the next thing Kevin said was inventory leads to operating expenses. Well, that's not true. Inventory becomes cost of sales. So what do I mean when I say that? If I scroll back up here to my income statement, costs of sales go here, and operating expenses are these: research and development, SG&A, restructuring, and other. Those are not inventory. Inventory becomes stuff that you sell to people. So that's cost of sales. And Tesla has a virtuous cash conversion cycle. What am I talking about when I say that? So if you come back here and you look at, oh no, look at all these accounts payable. This is a really big number down here, 11.2 billion. Well, that is the total accounts payable for stuff on which Tesla has already taken delivery of things they bought. So you're talking about raw materials, you're talking about parts, you're talking about the stuff that the factory uses to make cars and solar production and energy and whatever, right? So the terms that Tesla has with the people they bought that stuff from say that Tesla has 90 days to make payment on that stuff. A virtuous cash conversion cycle is when you can take delivery of that stuff, turn it into finished products, sell it, receive payment for it before you have to pay for the parts and the raw materials that you got in the first place. So is this a problem that Tesla has 11.2 billion of accounts payable? No, it's not a problem. Matter of fact, this is what you want. This is what you're trying to maximize the amount of time between taking receipt of goods and having to pay for them so that you have a chance to go ahead and sell the products and then, you know, have the money already to make payment on it. That's what you're trying to do, which is what I was trying to say in these notes. And we already looked at the global days of sales and ending inventory that tell us, hey, Tesla is really turning over inventory quickly and converting that into cash. Kevin said inventory takes time to be used and sold. Well, yeah, but at Tesla, it takes less than 90 days to convert it to cash. And that's why I don't exclude it. So what's really accessible is about $1 billion is what the nuanced math Kevin did got him to 21 billion of adjusted Kevin current assets versus 20 billion-ish of adjusted Kevin current liabilities. So no, if this were true, that Tesla only had about $1 billion of cash accessible, then how is it possible that Tesla has been funding capital projects and paying down debt early? And let's look at what I'm talking about here. And there's charts in here, and everybody likes charts, so we'll look at those. So here's what's been happening with Tesla's deliveries. They've been trending up. And here's what's been happening with Tesla's operating cash flows and free cash flows. So those have also been trending up with the exception of this most recent quarter, which we know there were some problems in with Giga Shanghai being shut down for lockdowns for or at reduced capacity for more than half the quarter. So that's what happened here. But what I want to draw your attention to is what happened during this time period. Did Tesla raise cash? Did they issue stock? Did they issue bonds? Did they borrow money? No, none of that stuff happened during this time frame. What did Tesla accomplish during this time frame? Did they build factories? Yes, they did. They built Giga Austin, they built Giga Berlin, they expanded Giga Shanghai, all during this time period where they weren't raising money. So if Tesla only has $1 billion available to spend, how did they do all of that and pay down long-term debt early at the same time? How could you do that if all you had was $1 billion available? You couldn't. So these red numbers are showing you the capital investments that Tesla was making. These are the investments Tesla was making in gigafactories, and they were funding it out of the blue bars, which is operating cash flows, which is what I explained is how Tesla is going to continue funding growth in the future without the need to raise cash by issuing stock or bonds. I hope that makes sense. There's profit over here. What other did we want to look at? So these are 12 trailing month deliveries, operating cash flows, free cash flows, net income, and adjusted EBITDA. So you see the right trends are in place here. These amounts continue to grow as Tesla expands and sells more vehicles, and it increases their profitability. The balance sheet continues to get stronger as Tesla pays down debt, and the cash balance, I think, is going to continue to grow in the future without the need to borrow or issue stock to raise funding. Hope that's clear. So Kevin said, if you take out the Bitcoin, the actual literal free cash flow would have been next to zero. Well, no. And I thought that he already admitted to being wrong about the negative free cash flow. But it sounded like to me he was doubling down on saying that you would take Bitcoin out. Well, that's not part of the free cash flow formula. The free cash flow formula is operating cash flows minus capital investments. So there's no Bitcoin in there. Bitcoin goes as proceeds from sale of digital assets as an investing cash flow, not part of that formula. So you're not allowed to take out the Bitcoin. And so that's point A. Point B, the Bitcoin was already an asset convertible to cash in less than 90 days. So when Tesla took that Bitcoin out of their right pocket, converted it into fiat currency, and put it in their left pocket, they still had the same amount of current assets as they did before. The Bitcoin just wasn't counted as a current asset previously because the dumb gap accounting rules say you're not allowed to count Bitcoin as a current asset. It is. You can convert it into cash in less than 90 days. People are doing it every single day. So he didn't count that as a current asset in his formula, which is why he still has it to be able to throw out of his nuanced math. But the other thing he didn't do in his nuanced math, he didn't throw out 3/4 of the accrued current liabilities for not being immediate expense, right? If your rule is, hey, it needs to be convertible to cash in the next 90 days, well, what you see on the balance sheet, and I'll show you what I mean, back on the balance sheet. Well, here's accrued liabilities another of $6 billion. How much of this is Tesla going to need to pay as cash in the next 90 days? Only 1/4 of it. This is the next year worth of accounts payable and accrued liabilities another, and deferred revenue and customer deposits, right? That's what the current liabilities section is telling you. It's giving you a full year. So if what you said you wanted to do was to convert this into what's going to happen in the next 90 days, well, Tesla owners aren't all going to bring in the next year's worth of repairs under warranty over the next 90 days. It's going to be spread over the next 360 days, but you counted the whole 6 billion of this when you did your formula. You should have only been counting 1.5 billion of it if you're going to be internally consistent with your rule that it needs to be in the next 30 days or the next 90 days convertible to expense or convertible to cash, depending on if it's an asset or a liability. All right, and back I go. Next point, Tesla just doesn't have the money to keep building factories. That's wrong. And if we look at the free cash flow charts in the investor release, which we just did, you can see on them where Tesla was building factories. Tesla did keep building factories since the last time they raised in September of 2020. They did have the money. They had it in operating cash flow. What if Tesla wants to build 3 more factories? They will, out of operating cash flows. So it would be different if we were doing a theoretical thought exercise here. If we were trying to imagine a hypothetical company that doesn't exist yet, then we could have a discussion about whether they would have enough cash to build factories, and maybe, you know, as many people would side with you as side with me. But in this case, the results are in. Tesla has been building factories using their operating cash flows without needing to raise more money. And that will only become more true in the future as Tesla's revenues and earnings increase and operating cash flows with them. Hope that makes sense. Tesla does not have the money people think they have to build more factories. Didn't you just say Tesla hasn't raised since September 2020? Those are incompatible notions. Tesla is going to have to raise more money. Well, since that time, Tesla did build 3 factories with no raises, and the cash balance has stayed over 17 billion that whole time. So how did they do that while they were paying down long-term debt at the same time? The only way they could have been doing it is by funding it internally, because they weren't raising money externally, right? So Kevin said Tesla is going to have to raise cash. That's wrong. They've been funding capital out of operating cash flows. And now that Tesla is down to 0 recourse debt, effectively, it's less than 0.1 billion at this point, that money that they've been spending to pay down long-term debt early is going to be available to either grow the cash balance or to invest in more factories or more capital or more supercharger expansions or acquiring other companies or whatever Tesla decides is the best use of that capital. Okay, so if Tesla had to raise money through borrowing, let's say they did, okay, even if they do that, most normal companies borrow money all the time. That is no big deal. Go look at any other big successful company's balance sheet, and what you will see is that they have tons of long-term debt. That's normal. And the reason investors don't care when companies go borrow money is that you're borrowing money at, I don't know, 4% to invest in capital projects that have a return of, I don't know, 12%. So the difference between those two interest rates says if this project that I invested in makes 12%, and if the interest payments on the money I borrowed to do the project are only 4%, then I'm making profit on the difference between those two interest rates. I'm clearing 8 points on every dollar that I borrowed. So investors ought to be happy with that if a 12% internal rate of return is in line with their expectations for what this company ought to be generating. Okay, or the other way to raise money is through stock. Okay, even if Tesla needs to raise money or decides to raise money, and they do so by issuing stock, okay, well, let's say Tesla raises $7 billion, which would be enough to build 2 more gigafactories. They're doing it for less than 1% dilution. How is that a huge concern for investors? It shouldn't be, because with those 2 additional gigafactories, Tesla will be growing their revenue by more, growing their earnings by more in the future versus what Wall Street expects today. That raises the EPS forecast for future years. That makes the price of the stock go up by more than 1%, which is the dilution that would occur against the ownership interest. So this is a fair trade that a Tesla investor ought to take 100 times out of 100 if that's how Tesla decides they want to do it. Next, he said, mark my words, Tesla will raise money in the future. Okay, no big deal if they do. I'm prepared. Kevin said, Tesla perma bulls are not prepared for Tesla to raise money. I'm fine if Tesla decides they want to raise some money. But I'm not going to be surprised if they don't, because they don't, from where I'm sitting, Tesla doesn't need to go raise money. But it's fine to raise money. Companies do it all the time. Successful big companies are constantly raising money to invest in stuff. So that's also okay. I just don't think it's necessary like Kevin does. All right, without the Bitcoin, Tesla would have grown their cash a negative amount. Well, no, the Bitcoin was convertible to cash in less than 90 days. I hope that point's clear. They sold their Bitcoin for a gain. I'm sorry, I made a mistake. Okay, I agree with that. And we all make mistakes, and the impairment is confusing stuff, so no worries on that. I make mistakes sometimes too, everybody does. Every time I make a forecast, every number I forecast is wrong, because the first rule of forecasting is whatever you forecast, it will be wrong. So you got to get comfortable with being wrong sometimes if you're going to make forecasts, and I am. And it's okay to be wrong sometimes. That's what we're all here for, is to learn, to continue to grow and be less wrong. If the US goes to war with China, there's going to be problems. I agree with that sentiment. Yes, there would be problems if the US went to war with China, but that risk would affect a few more companies than just Tesla. That's not a Tesla specific risk, right? That's not what made Q2 earnings a disaster, that the US might go to war with China. I assign a very low probability to the US going to war with China. That seems unlikely to occur to me, and I'm not gonna stress out a lot over that scenario. Then the last point he made, his last parting shot, was that Model S and X profit margins, he says, are probably $80,000 per vehicle, which would be way over 50% gross margin. And I disagree with that assessment. Now, I can't prove that he's wrong on that estimate because Tesla doesn't release that data, but the estimate sounds super high to me. So with that, I will stop sharing my screen and say, hey folks, if you haven't taken my 50% discount coupon off my course, that expires on July 28th. I'm kidding. I'm kidding. I don't have any course and I don't have any 50% discount. What I have for you is a 100% off discount on all of the materials that I make available here on YouTube and also on Twitter. You can follow me on Twitter at @ICannot_enough, and turn on notifications for me if you want, and that way you will benefit from all of the content that I'm sharing freely and publicly with people. If you want to support what I'm doing, you can like this video. That's supporting me. You can subscribe to my channel on YouTube. That would also be helpful support. I do have a Patreon page, and there is a thanks button in YouTube. So if you have more money than you know what to do with, if money is cluttering up your money bin, if you're way ahead of your personal investing goals for retirement and feel like you've got some unwanted money you want to get rid of, you can really help my channel by saying thanks with it. Or just, type the word thanks, exclamation point. That's awesome too. Or if you don't want to do any of that stuff, my course is free. So yeah, so like, comment, subscribe, hit the notification bell, all the stuff YouTube people say at this point in the video. And I will see you in the next one.